Welcome everyone to Coffee Break with CRIF. Today's topic is the affordability advantage, why leasing belongs in your loan mix. A conversation on leasing, affordability, and dealer partnerships, and why more credit unions are taking a serious look at leasing today. We've got a great lineup for you. Joining us is Scott Swan, Senior Vice President of Consumer Lending at Directions Credit Union. He's been at Directions for 28 years, where he oversees consumer lending strategy and portfolio growth. Alongside him is Chris Harper, Director of Business Development at Credit Union Leasing of America. Chris brings 31 years of experience across credit unions, auto finance, and dealerships, helping credit unions launch and grow successful vehicle leasing programs. And hosting today's conversation is our very own Kelly Caven, Vice President of Sales at CRIF, with over 20 years in financial services, helping lenders strengthen automotive lending through technology, automation, and dealer-centric solutions. Just quick housekeeping, this session is being recorded and will be sent to all registrants. Lines are muted, so drop your questions in the Q&A box and we'll get to them at the end. And don't forget that coffee gift cards are going out in the next couple of days to all valid credit union employees who registered and attended. With that, let's get into it. Over to you, Kelly.
Great. Thank you, Andrea. And thank you, Scott and Chris, both for joining us on this month's Coffee Break with CRIF. I'm excited to dig in and talk about leasing with you both. So let's start with the big picture. Leasing has traditionally been dominated by captive lenders. And we're seeing a lot of interest from credit unions. So Chris, if you could start us off here and maybe help us understand what's driving that shift and why leasing is gaining momentum.
Yeah, absolutely. Thanks, Kelly. It's an interesting topic. I hear this question all the time. Why would it work for credit unions, when captives have owned the leasing market for so long? And it's an interesting dynamic with the leasing program when it's done through a third-party leasing aggregator such as ourselves. It's really designed and enabled us to capture and target segments of the market that are being neglected from the manufacturers. I'll give you a prime example. Toyota decides we want to advertise a $299 payment on the Camry. And everybody gets excited, gets a lot of advertising on TV, drives folks into the dealership. But what they do is they neglect the RAV4, the Tacoma, the 4Runner, and enables our program to come in and really wrap around those subvented programs to really drive leasing volume. And obviously we know credit unions, every one of you on the phone, have phenomenal interest rates. So we have great rates that we can translate with a dynamic program that enable us to offer payment savings versus the manufacturers anywhere from 20, 40, as much as $100 difference than the manufacturer payment. And with affordability such a key issue, dealers are latching on to the opportunity to offer even lower lease payments than they get from their dealer OEM partners.
Wow. That's surprising. I didn't realize that, until you and I talk a bit more about those specific makes that I think people just don't, think about when they think about leasing specifically. So, Scott, from Directions perspective and the credit union's perspective, I know Directions Credit Union has had a successful leasing program for, I want to say well over 20 years. So if you recollect, anyway, let's take us back a little bit to what first made leasing attractive for Directions and why it continues to play an important role for your lending strategy today.
Great question. Thanks, Kelly, and it's good to be with you all today. As Kelly mentioned, we've been a leasing lender for well over 20 years, and I should preface that we've been a partner with both CULA and CRIF for that same time. When we entered the market, it really had provided us an opportunity to expand our indirect program and diversify our loan portfolio. And really, while those benefits remain true today, the value of leasing has evolved significantly and extends far beyond that diversification. If you think about what we're dealing with today, it's all about affordability. So today, our leasing program plays an important role in supporting vehicle affordability for our members. As vehicle prices and monthly payments have reached historically high levels, leasing continues to provide our members with an alternative path to driving a new vehicle while maintaining a manageable monthly payment. Another strategy or advantage is leasing enables us to meet our members where they are, and that's at the point of purchase. While we all strongly encourage our members to secure financing with us before they visit the dealership, leasing decisions are typically made within that environment. So without that leasing option, credit unions really risk and miss the opportunities to serve members during a critical financial decision and really may lose that relationship to other lenders as well. I think another significant advantage of leasing is its impact on member retention. So unlike traditional loans, traditional auto loans, leasing follows a predictable maturity cycle that creates, regular opportunities to reconnect with the members. So these reoccurring touch points allow us to proactively engage members. At lease termination, upwards of 80% result in the opportunity to fund a new lease, a retail purchase, or the buyout of that lease. So engaging with the member and providing that positive experience allows us to, be top of mind for future transactions.
Yeah, I think the perception on, indirect automotive is it's a one and done. So it sounds fantastic to have that leasing option, knowing that especially in upwards of 80% of your members are turning it in and releasing or refinancing or keeping that car. So that's impressive for sure. And we talked about affordability a little bit, but let's dig into that a little bit more. Scott, obviously with it being probably the biggest challenge that our, buyers are facing today, talk a little bit more about how this has helped your members get into vehicles that they might have, kind of otherwise been out of reach.
Yeah, I mean, you hit the nail on the head. Affordability is huge in the auto space. That's been one of the fastest growing price increases, and I think Chris is going to touch on that here in a moment. But with vehicle prices remaining elevated and higher interest rates impacting monthly payments, many members find the vehicle they want or need, but it's outside of their budget. So really, leasing has given our members another option because the members are only financing the portion of the vehicle that they use during the lease rather than the entire value of the vehicle. The monthly payment is significantly lower than a comparable purchase payment. So that lower payment can make a newer, safer, and more reliable vehicle attainable when it otherwise may not be. For many members, leasing has helped bridge the affordability gap, like we've touched on. Instead of settling for an older vehicle that may have higher maintenance costs, they can drive a newer vehicle equipped with the latest safety features, again, while keeping that budget intact. In some cases, members have been able to move into a vehicle 1 or 2 model years higher because they could comfortably afford the payment using the lease. Yeah, I think I'm sorry, just and lastly, from our perspective, leasing isn't about putting the members into the vehicle that they need. It's about providing flexibility and choice. We want members to understand all of their options and select the solution that best aligns with their budget, their driving habits, and their financial goals. So members who prefer lower monthly payments and typically replace their vehicles every few years, leasing has proven to be a very valuable affordability tool.
Yeah, no kidding. I like what you said about, obviously safety with, I've got teenage drivers and all of that, and just knowing that they're, that, or it's not going to break down, the month after you purchase it. So I couldn't agree more with that. Chris, do you see affordability as the primary reason credit unions should be paying attention to leasing right now, or are there other factors they should consider as well?
Well, from a credit union perspective, there obviously are going to be other factors, but I think when you look at the member first, which is what credit unions do, affordability is overwhelmingly the number one factor. There's a great survey out there where they asked members why do they lease versus buy, and it was everything from predictability of payments to if cars under warranty the whole time. They wanted the newer equipment, but overwhelming, over 60% of respondents said it was affordability. It was the lower payments. And you can see on the bottom of the screen there, according to Experian, the average lease payment is $151 less than a comparable 72-month financing. That's dramatic. And we find that our partners, again, touched on earlier, credit unions, we have phenomenal interest rates. We're able to pass that along for these programs. We see that savings in upwards of $180 on average for the members who are getting a lease through our credit union partners. And that's so important because affordability is top of mind for everybody. You can see to the chart just to the right there that the average lease payment, over 60% are under $600. 45% are under $500. And again, I know that for some of us old timers with the gray in my beard, that's a high payment. But in today's world, that's a much more affordable payment, considering almost 19% of all new car payments exceed $1,000. And one of the dynamic elements of this affordability challenge is who that's really impacting. And you're seeing this mostly touch those younger millennials and the Gen Zs. And it's interesting enough fact for you all is millennials are 2 times more likely to lease than their Gen Z and boomer predecessors. And millennials are 3 times more likely to lease. So again, I don't know a credit union who doesn't say we want to grow membership and we want to grow younger membership. This becomes another one of those tools, but it's because of that affordability factor. Those consumers are less tied to ownership, and it's all about that payment. And this is really that driver to get those lower payments. I think you have a couple other stats for me if you want to jump ahead there, Kelly.
For sure.
That always just think is great for the audience to know when we're really diving into affordability. Again, it's the rising vehicle cost. You can kind of see that chart going up, and you saw at the end of 24 was just under 50,000. At the end of 25, first time ever, the average vehicle transaction price was over 50,000. And just this year alone, according to Experian, it's gone up another 5.15%. We're expecting by the end of the year that average vehicle price might be closer to 53 to 54,000 for a average vehicle. And so again, it's just a dramatic rise. And I think the next slide will really kind of hit the nail on the head on that rise on those. As you can see, a car as it relates to inflationary factors. And again, if you have a kid in college, you see that public college line in there. I feel your pain because that obviously has skyrocketed. But aside from that, and maybe a couple months ago, the price of eggs, the most impactful thing in terms of the monthly budget to your members is the new car price. It has risen so much and is capturing so much of that wallet share. It's harder for them to afford other items. So really finding ways to shrink that payment is paramount. And a main reason why most credit unions are talking to us today is how can they help their members, weather the financial storm and then put themselves in better financial position, which is what we're all striving to do.
Yeah. I like what you said about the younger members. I mean, I think there's even those programs out there that you can kind of rent a car for a day. So that sense of ownership really is going away with the younger generations for sure. So I think leasing is an absolute fantastic opportunity for those. Let's shift gears a little bit. Let's kind of talk about the dealers. Dealers are looking for partners that can help them, close more deals, serve more customers. Chris, where does leasing create opportunities for credit unions to differentiate themselves at the dealer level?
I think this is one of the key elements, particularly if you're a credit union that has been doing indirect lending for a while. You're adept at it. You're capturing market share, but you're saying, how do we grow? How do we find more in the space? Leasing really becomes that element. One aspect of it is you become a holistic lender to the dealership because you offer in every segment of member who walks through the door a solution. Right now, credit unions who aren't offering leasing, it's very hard for them to tap in and capture that high A plus new car borrower because that's where the captives are offering their subvented rates. So unless we want to fight the 0% or the 1%, 0.9 rates, it's hard to get into that space. Leasing allows you to compete in that space so you become more valuable to the dealership as a whole. The other big segment where this allows you to really stand out and differentiate yourself from your competition in your marketplaces is the opportunity of offering a lease enables you to have new conversations at the dealership. One of the most dynamic things that goes on in the dealership is that a lease is owned essentially by the sales tower. I know if you're doing a robust indirect program today, you're spending a lot of time engaging with those finance officers, and that's still an important role. You have to work with the F&I personnel on a regular basis. But leasing allows you to elevate your conversation to the general managers and the sales managers at the dealership, makes you become a more valuable lender to the entire organization. In doing so, we help support our credit union partners, much like CRIF does, by having boots on the ground out there to help support that effort, to engage those conversations on the sales side of the equation, to really make you much more visible and seen at the dealership. You become a valued partner. And in many of our markets, the dealers actually will embrace the programs that they're offering. I mentioned how in many cases we have payments $80, $100 cheaper, and they use that as an advertising tool to bring in new customers to the dealership. And it's because of that strong partnership that they're feeling with their lending partners and their credit unions.
Yeah, I didn't even realize that, like the kind of conversation shifts based on the role there. So I love that kind of ingraining yourself more at the dealer level. Scott, from the credit union side of the house, has having lease options changed the way that your dealers view your organization or open doors that may not have existed before? And how's that relationship changed?
Yeah, I'm going to echo a lot of what Chris just stated. Our leasing program really is a nice complement to our indirect program. I tell you, we feel a lot more confident, even if it's a new dealership or existing dealership. And as far as how we structure those conversations. We absolutely strategize in who we're going to target from the lease perspective. That absolutely happens at the sales desk. So we've got internal business development folks that again complement what both CRIF and CULA are doing with their boots on the ground. So we can all work together to drive as much business and make sure that the dealers understand what our program is and keep us top of mind. So that's absolutely changed the way that we approach, those interactions with the dealers. The second thing I'll point on, and I'll go back to a comment that Chris made earlier, is that, in the lease space, it is very dominated by the captives, and captives pick and choose which vehicles that they really want to, be aggressive and go after. Well, what CULA provides to us is they provide basically a breakdown of every model that's out there that's available to be leased, and they'll have payments. They'll have their payment versus what our competitor payments are. And this report is very important because what we can do is we can take this and turn this into something tangible and actionable. When we go into a dealership, obviously the main goal is for us to finance as many vehicles as we can. But our approach with the dealer is we're trying to help them sell as many vehicles as we can. And in the process, we believe that we'll capture our fair share of that. And so what our team does is we'll look at the inventory that's currently on the lot there. We'll take the report that CULA provides to us, and we'll go in and we'll tell the dealerships exactly what vehicles that we believe that we can help them sell. And that has helped really those conversations. It really has allowed us to go in there again from a more strategic aspect than just going in from the relationship piece of it. They're very busy, so their time is valuable. So if we can bring in something tangible and we can provide a conversation that's ultimately going to help them move more units, then we feel like that's just a win-win for everybody.
Wonderful. That's great. I want to remind everybody too, if you have questions, please throw them in the chat. We'll absolutely have time to get to those here as we kind of wrap up our questions. So please throw those in there. We'll be sure that they get answered. Let's kind of shift gears to an operational perspective. I think I believe it's 30% of your portfolio, Scott, if my memory serves, is leasing. So a very, large capability to diversify and whatnot. But I think when it comes up, people often assume that it's complicated or risky. So can you talk a little bit about what's involved operationally and kind of what's helped your team run a successful program?
Absolutely. I think this is a really important question. And I think this is where the partner is super, super important. And, our partnership with CULA has been very valuable because, again, they've been there to help us through this process. One of the first things that I'll touch on when you think about, implementing a leasing program, a few of the things are residual risk. So as I mentioned earlier, the member's responsibility is just on that depreciated piece, but the credit union's responsibility is on the entire balance of that. So even at the time of termination of the lease, that remaining balance and what's left over, it's still very important to ensure that the value 2 or 3 years in the future supports that. So having good analysis around that is absolutely key. And I'm going to circle back to that here in a minute. But the second thing I want to touch on is from the compliance piece. Obviously from disclosures, from the timing of disclosures, the delivery of those, again, having the right partner to ensure that you've got everything as it's supposed to be, your I's are dotted, your T's are crossed, super important. Another component is the accounting aspect of it. There are a lot of transactions that take place during the lease process. There are, upfront fees that have to be deposited to specific GLs. Obviously, there's dollars and fundings that go back and forth between not only the dealer, but as well as CULA. So ensuring that you've got the right process in place, that you've got, again, all of the correct GLs established, that your ACH pieces are in place, really important. The next thing, again, I think that needs to be a strong consideration is your processes. So the end of term processes is very important. And there's multiple ways that an end of term can take place. You could have a trade-in with the dealership on a new transaction. At the end of termination, the lease could just be turned in. The member may choose to buy it outright. The member may choose to refinance that vehicle. So ensuring that you've got really sound processes in place that can manage that transaction through the end to ensure that, again, title work is done appropriately, that again, any remaining balances are taken care of. If there's any over mileage or extra fees that have to be taken care of, There could be a collection component that needs to be brought into that. So, it's really important that all of those processes and all of those pieces are established and sounded in place. And where, again, I think it's important that you have the right partner, and where CULA has been a really, really good partner with us is, I'll circle back to the residual risk aspect of that, is they very regularly are sharing that analysis with us. So, at every lease inception, there is dollars that is ultimately deposited into, for lack of a better term, a loan loss account. And these dollars basically sit there and they protect for any future losses if there's any shift in the market that may affect the end residual value. And so it's really important that from the lender perspective that we understand that we understand what the expected future losses might be, and that we understand what the state of that holdback account is, because again, that's our first line of defense to mitigate any residual risk. And if you have a sound and appropriate portfolio, you're not only going to be a break even on that if all of your units were to turn in at once, but you'll have some extra left over in that holdback account. Again, that just provides for a nice buffer. So, again, I think there's a lot of components that really need to be put in place. It's not complicated. Just you need the right partner that can help you through that, get yourself established, and it can be a really, really, really good program.
Wonderful. Thank you for sharing that. Chris, from CULA's perspective, for credit unions that are considering leasing, what should they be thinking about before they get started? And where do you feel that organizations tend to run into challenges?
Well, Scott did a great job of elaborating on some of the challenges there. Obviously, residual value risk is always an element everybody should consider up front. Scott touched on the methodology that we use. I'm glad to explain it to anybody if they have any deeper queries, but it's designed to protect the credit union for those scenarios where they might turn in a car. Again, then you have the operations side. But I would tell you two key areas that I get asked a lot are how well does the system or the process work with their delivery channels? And you see on the side there, the dealer track and route one element. How easy is it for it to the dealer to play and send the deal to the credit union? That's a key element. You don't want to make it an extra step in the journey for the dealer. If they have to do an extra click, go to an extra screen, it changes their likelihood to even use you. So the fact that this ingrains right into the process through CRIF into the dealer track and route one channels, so that it can be easily submitted to you right into your LOS platform for underwriting, is a key element. You don't want to create any speed bumps or hurdles in that journey. So that's one of the key elements in there. The other is a question I get asked a lot. And then there's a third, which Scott touched on, which is the turn-in process. I'll mention that at the end. But the other that I get asked a lot about is the actual processing of the lease itself. And this is where I think a partnership with CRIF comes so valuable, is that process of, okay, we've got a lease package in, we're ready to fund it. And candidly, it's a new process for a lot of credit unions because it's a different document than you have seen for 20 years doing a retail installment contract, the old law contract that everybody knows. Well, now you're looking at a lease document. Numbers are in different spots. Again, there's some additional accounting elements involved in there. But when you can have a trusted partner like CRIF who can handle and manage that funding part of the journey, it makes you able to scale faster, scale larger, and not have any lag in that process. Because the last thing you want, if you've done indirect for a while, the last thing you want is to become known as the one who can't fund on time. So those who want to kind of try it on their own, that always becomes that added challenge of we want to make sure that we're maintaining the standards and expertise that's needed to get these dealers paid. If you haven't talked to a dealer lately, their most important stat out there is contracts in transit, CIT. That's, it used to be how much money they're making, what's the gross on the car. Now it's how fast do they get their money. It is so important to understand that part of the journey. So having a trusted partner in that part of the journey really enables you to hit the ground running and do it in a manner where you're going to meet the standards of these dealers, so that you're not going to lose opportunities because you can't pay them on time in that journey. So it really streamlines that process. And then, of course, that third element is that lease end journey that Scott had mentioned, those turn-ins at the end. And that's always a concern of every credit union. If they investigated leasing 20 years ago, there's a process where credit unions were responsible for that part of the journey. That is nothing that we do. The CULA actually manages that entire lease end process, from everything engaging with the member, collecting and inspecting the car, taking it to auction, and then delivering those proceeds back to the credit union so they're paid off. Because again, no credit union wants to have to worry about having cars dropped off at their branch or sitting in the back of their headquarters parking lot. We manage that entire process, take it off of your account management teams, the customer care teams, and handle that all the way from start to finish. So those seem to be, again, Scott did a great job talking about the residual piece because that's always a key element. I think operationally making sure that the pipes all work and that it goes everything from the Route 1 dealer track delivery in to making sure we fund them quickly. And then, of course, how do you handle it at the end? Those are the three big considerations, and that's how we try to mitigate it.
Wonderful. And you are right. Dealers are absolute path of least resistance, folks. And I've sat through those CIT meetings, and they are scary. So you're absolutely right about that. Wonderful. Well, let's look ahead a bit. And Chris, as we think about the future in auto financing, a lot of the trends we discussed today are not going away. So where do you see leasing fitting into the long-term strategy for credit unions?
Again, starting with affordability, I don't think those challenges are ever going to go away. Even if we see inflation come down, wages go up, people tend to spend every penny they got in their pocket, unfortunately. And so mitigating their expenses is going to be important. And so you can see here on the kind of the national lease penetration, you see those numbers. And again, you see pre-COVID, it was exceeded 30%. And then COVID came along and those numbers dipped. And that was mostly driven by the fact that the captives, they didn't have to offer any incentives to sell a car at that point. There was no inventory on the ground. They didn't have to do anything unique to be able to sell a car. Well, you can see those numbers rising up again to over 25%. Subtle dip there, the end of 25. And that was driven solely by the fact that the EV tax credits expired. So in Q4 of 25, you saw a contraction of EV leasing, which drove that down. That being said, going back to what I mentioned earlier about the millennials, the Gen Zs, as more Gen Zs get into the buying market, you're going to see this number. The expectations, Morningstar says this will be over 30% within the next 2 years. Fortune Business Insight says it's going to grow at 7.8% compound annual rate until 2029. So you're looking at a percentage that would put you in the mid 30s. And in many places, like Scott's market in particular in Ohio, the state of Ohio as a percentage is right around 30%. But the market he's in, over 48% of all the new cars are leased. So you're seeing these pockets. So even if you're in a state, you go, Chris, I'm in Tennessee. I don't know anybody who leases. Well, if you cover Nashville leases at a 56% rate. So the dealers in those metro areas are seeing leasing continue to grow as a key tool to sell cars. And it's a key element to how members and consumers in those markets are growing forward. So this trend is not going away, and even kind of an offshoot of that is even used car leasing. While it's a small percentage nationally now, just hovers under 3%, is expected to see a growth over the next several years as well. Just because as these new car prices I showed you over by the end of the year probably be 53, 54,000. Used car prices are elevating with that, and so again, it just makes even getting a used car that much more problematic. So offering a lease on a used car. So again, you're going to see it on both segments, this continued growth, and it will not be unthought of that with, by 2030, that 40% of the entire new car auto market will be leased going forward.
Wow. Scott, from your perspective, obviously you've got your credit union peers here on the phone or on the line with us here, and for those that may still be on the fence, what's your advice based on your experience, your results? We talked about obviously 30% of your auto portfolio being leasing, so it's a large part of your program. We talked about 73% of those members are either getting a new lease or getting a new loan or turning those in and doing something else more with the credit union, so it creates that stickiness. But what advice do you have for those that might be thinking about it?
Yeah, you're correct, Kelly. I mean, upwards of 30% of our indirect originations each month are in the leasing realm. And I guess my advice or my response would be, if your goal is to improve member affordability, if it's to increase member retention, if it's to compete more effectively with captive lenders and create reoccurring opportunities to deepen relationships with your members, leasing is absolutely worth exploring. The question isn't whether every member wants a lease. The question is whether you're losing members today because you don't offer one. And so just a couple of additional things that I would point out is that, leasing gives you the ability to attract a different member segment. Maybe you're a shop that is really good with used auto lending, but you really struggle with capturing some of those new autos. leasing might allow you to do that. It may open up a new segment that solely focuses on that. The quality of the portfolio is very strong. Over the last 5 years, our charge-off has been 16 basis points. So again, it's quality paper where you get paid back on. Again, I mentioned it creates the member touch points. It's a predictable maturity cycle. Again, so you can create journeys based on that because you know exactly when that lease is going to mature, and you can start to prepare for what those next steps might look like for that member in their next purchase. Lastly, again, it just continues to help strengthen the relationships with the dealers. 70 to 80% of all auto transactions still take place at the dealership. So it's important for us to establish ourselves as being somebody that is, again, somebody valuable for the dealer to turn to. Again, those are the things that I would focus on. I think leasing absolutely should be something to consider. Again, I think it's another outlet to support our members and to provide them through their financial life. One final thing that I'll add, again, I started the discussion off that, we've here at Directions, we've been a 20 plus year partner with both CULA and CRIF. And I will tell you over those 20 years, the relationship has been solid. They've allowed us to scale up our program. They've allowed us to improve our workflows and, again, just continue to be a great partner with strategy. So if you're considering either one of them, I think it's something you should continue to look at because, again, it will certainly benefit your credit union, benefit your members, and just give you another outlet to increase your loan growth.
We appreciate that, Scott. Thank you so much. And we appreciate your partnership as well. Thank you both for sharing your insights, your expertise. I'd love to pause now and see what questions our audience has. And Andrea, if you want to facilitate, if you have anything in the chat,
For sure.
We'd love to allow a few minutes for any questions that anybody might have.
Yes, we have a few questions. First one, what's the biggest mistake you see credit unions make in their first year of leasing?
I'll start with that because I see a lot of credit unions who do it. And I would say it's the best way to explain it is say drink through the fire hose. A lot of folks say, hey, let me get all the volume I can because it becomes a new segment that you're not tapping into regularly. And in many markets, the dealers are starved for an alternative to the captive. So there's the possibility of getting more than you can handle. And while, again, I don't ever think volume is a bad thing, I touched on it earlier with the expectation of the service level you're going to provide once you get that deal for funding is making sure, can you then provide the turnaround to make sure you're paying that dealer on time? It's great if you got 100 new deals, but if you paid the dealer late on 95 of those deals, you won't see 100 the following month. So you need to make sure that you have your processes and procedures in place. So we want a very deliberate, at least from the CULA side, we want a very deliberate ramp up into the program to make sure the pipes don't leak, to make sure your processes are in place, that you feel comfortable ingesting what you're getting. The volume will come and the volume will sustain over the long haul. Trying to do too much too fast tends to create a challenge that you can't overcome from in the future.
Yeah, I would agree with that 100%. Another piece is to ensure that the operations side is sound. As Chris said, crawl before you walk. By tempering those expectations and the volume allows you to ensure that your operations piece is intact, that you've got the right processes in place. And the other thing that I'll say is consistency. I think one of the things that you don't want to get involved or get in a habit of is making a bunch of changes to your pricing or your program. Because from there, then, it's just one other additional thing that the dealer has to continue to try to remember or adjust to. So, be consistent and ensure that you've got your operations in place.
Perfect. Thank you. There's one more. How do credit unions in low lease penetration states know if leasing will actually work in their market?
Well, I touched on this a little bit earlier, and I can provide the analytics to anybody who has questions. But even what we deem low leasing market states, I kind of use Tennessee as the example of, the statewide, the number is only 8%. Of course, it's not really there. But again, the city, the greater Nashville area leases in excess of 60% of all new cars are leased. So there's going to be pockets in every region that have the metro areas where, again, you tend to have your bigger dealers, you tend to have your higher volume dealers who are also using leasing as a main tool. So I often say that, when you look at a large state, you can have 50% of the volume come from one geographic region that leases a ton, but the average is dragged down by the more rural parts of the state. So I wouldn't let the thought of, hey, we don't have a whole lot going on here sway you, because your metro areas are leasing. There's not a metro area that's not exceeding the national average as a whole.
Perfect. Well, that's all we have for questions. Looks like we're wrapping up a little bit earlier today, so it's like a true coffee break, so that's great. I just want to say thank you to Scott and Chris for sharing their insights on leasing and affordability, and to Kelly for guiding this conversation. Just a few reminders on your way out. The recording will hit your inbox in the next few days, along with the coffee gift cards for registered credit union employees. Thank you for spending your coffee break with us, and we'll see you in the next one. Oh, and here's their information if you want to contact any of them. So
Yes.
thank you all.
Thank you, Andrea. Thank you, guys. Yeah, please do not hesitate to reach out to any one of us with any questions you have. But thank you guys for taking some time with us today. So appreciate you.
Thanks all.
Appreciate it. Thank you.
All right, guys. Take care.